What are some intraday algorithmic strategies that are easy and simple to trade? When discussing intraday algorithmic strategies that are both easy and simple to trade, it's important to recognize that such strategies leverage the power of automation to execute trades quickly and efficiently. These strategies are particularly useful for traders who wish to take advantage of small price movements throughout the day without being glued to the screen for hours on end. Let me walk you through some of the easiest intraday algorithmic trading strategies and provide more examples of how they work in practice. One of the most beginner-friendly and widely used strategies is mean reversion. The core idea behind this strategy is that prices tend to revert to their historical average after they've strayed too far from it. For example, if you notice that a stock like Apple has dropped far below its average price due to short-term market fluctuations, you can set up an algorithm to buy the stock, assuming it will return to its mean price. Conversely, when the stock rises significantly above its mean, the algorithm can trigger a sell order. To give you a more specific example, say the price of Apple is $140 on average, but after some volatility, it drops to $130. The algorithm might detect this as a buying opportunity, predicting that the price will eventually move back to $140. Technical indicators such as Bollinger Bands are often used in this context. These bands create upper and lower limits around the price based on volatility, helping the algorithm determine when the stock is oversold, buy, or overbought, sell. This is particularly effective in stable or range-bound markets but may produce false signals during extreme volatility, which is something to keep in mind. Moving on to the trend-following strategy, this is another relatively easy and well-known approach in algorithmic trading. This strategy attempts to capitalize on a stock's directional momentum by riding trends, whether upward or downward. A classic example of this is using a moving average crossover system. For instance, if the 50-day moving average of a stock crosses above the 200-day moving average, this is typically a bullish signal, prompting the algorithm to buy. Conversely, if the 50-day moving average crosses below the 200-day moving average, it's a bearish signal, and the algorithm would sell. Let's take Microsoft as an example. Suppose its 50-day moving average moves up and crosses over its 200-day moving average. The algorithm, detecting this as a sign of an upward trend, would buy the stock in anticipation of further gains. While this strategy is easy to implement, it does have its limitations. In sideways markets, when a stock isn't moving in a clear direction, this strategy may generate losses as it reacts to small, insignificant price movements. Still, for trending markets, it's a highly effective tool. Next, we have the momentum-based strategy, which is well suited for traders looking to take advantage of sharp price movements. In this strategy, the algorithm buys assets that show upward momentum and sells those exhibiting downward momentum. Momentum is usually gauged through technical indicators such as the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD. Let's say you're trading a stock like Tesla. If the RSI indicates that the stock has strong upward momentum, RSI above 70, the algorithm would buy the stock, anticipating that the trend will continue. On the other hand, if the RSI drops below 30, signaling that the stock is losing momentum, the algorithm would trigger a sell order. This strategy works particularly well during times of high volatility, where prices move sharply in short periods. A good example would be trading on major market news or earnings reports, where momentum can drive rapid price increases or decreases. However, this strategy also has its risks. In choppy markets where prices fluctuate without a clear direction, the algorithm may generate false signals, leading to potential losses. Another popular and easy-to-execute approach is scalping, which is a high-frequency trading strategy that focuses on making numerous trades to capture small price movements. Scalping algorithms are designed to make profits from very minor fluctuations in price throughout the day. This strategy is often employed in highly liquid markets, such as trading large-cap stocks or popular forex pairs like EUR/USD. For instance, you could set up a scalping algorithm to trade Google, Alphabet, stocks, which are highly liquid and experience numerous small price changes during the day. The algorithm might buy at $2,500.50 and sell at $2,500.70, profiting from this tiny price movement. Even though the profit from each trade is small, the high number of trades can generate substantial cumulative gains by the end of the day. The key to successful scalping is executing trades at lightning speed and minimizing transaction costs. Without an algorithm, this would be impossible for a human trader to achieve due to the sheer volume of trades required. However, scalping requires advanced infrastructure, as executing these trades in milliseconds is crucial to profiting from the price changes before the market adjusts. For traders dealing with larger volumes, the VWAP, Volume Weighted Average Price, strategy is another simple yet effective approach. The VWAP is an average price weighted by the volume of trades for a particular security, and many institutional traders use it to ensure they are not significantly moving the market price with their large trades. The algorithm aims to execute trades at a price that's better than or equal to the VWAP. Let's say you're trading a high-volume stock like Amazon. The algorithm calculates the VWAP throughout the day and buys the stock when the current price is below this average, ensuring that you're entering the trade at a favorable price relative to the market's volume. This strategy is especially useful when trading large amounts of shares because it helps avoid causing drastic price shifts, which could result in worse execution prices for large orders. Finally, the breakout strategy is a simple yet powerful technique that involves identifying key support and resistance levels. When a stock breaks through one of these levels, it can lead to significant price movements, and this is where the breakout strategy comes in. For example, suppose you're monitoring a stock like Facebook that's been trading in a range between $280 and $300 for several days. If the stock breaks above $300 resistance, the algorithm would trigger a buy order, assuming that this breakout will lead to further price increases. Similarly, if the stock breaks below $280 support, the algorithm would sell, expecting further downward movement. Breakout strategies are particularly effective during periods of high volatility, as breakouts often signal the beginning of large price moves. However, they can also lead to false breakouts, where the price briefly moves past a support or resistance level before reversing direction. To avoid false signals, some traders incorporate confirmation indicators, such as waiting for the price to stay above the breakout level for a certain period before executing the trade. In conclusion, intraday algorithmic trading offers a range of strategies that can be implemented with ease, even by traders who are relatively new to the concept. From mean reversion to breakout strategies, there's something for every market condition, whether the market is trending, volatile, or range-bound. These strategies can be automated using trading platforms like Strategy QuantX, enabling traders to execute trades quickly and efficiently without the need for constant manual intervention. The key to success lies in selecting the right strategy for the current market environment and fine-tuning your algorithms for optimal performance. With the right approach, even simple strategies can deliver consistent and profitable results in intraday trading. Thank you for watching.